Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me, Sonal Bhutra, and the mid-cap screen is finally green. The mid-cap index is up 1%. Today, there is outperformance, a decent advance decline ratio, nearly 2 stocks advancing for 1 stock declining. You know, the mid-caps have gone through so much pain, individual stocks. Even at the index level, the index is down close to about 5.5% this month. And from its highs, recent highs, it's down close to about 7%. But today, you are seeing a rebound. Even the small cap index. At the index level, that's the Nifty and the Sensex, there has also been a recovery. The Nifty low today was below 24,400, and now we're bouncing back towards 24,550. So firmly in the green now. The dip came just about 9:30, 9:40, but after that, things have picked up for the markets. We're holding on to the gain, and look at the way the IT stocks are moving up. The Nifty IT index is up 2.5%. Persistent, Coforge, these are names with a 10% rally. We'll discuss this in greater detail on the show, but that's clearly the sector of the day.
Sector of the day for sure, and it's a 160-point recovery thanks to the IT space today, right? That's the kind of move that we are seeing. And after 2 consecutive days of a 1,000-point fall on the mid-cap index, this is something that the bulls would like. It's a 640-point uptick on the Nifty mid-caps. The small caps, that index is up around 1.5%. We also have some comeback which is coming in from Nifty Metals, that index up 1%. There's Auto Index which is up 0.8%. But we do have some names which continue to be under pressure. The CPSE basket, for instance, is under pressure. Yet again, we have the private banking names, some of them under pressure. But nevertheless, after the big fall that we saw over the last 2 trading sessions, this has come in as some relief for the markets. So let's do just that and discuss market fundamentals. We have Niket Shah, CIO at Motilal Oswal Mutual Fund, joining in now to discuss the way forward for the markets as well. Niket, good morning. Thank you so much for joining in. Well, you know, today we are seeing a bounce back, but this is coming after that fall that we saw over the last 2-3 trading sessions. What's your sense? Is there more pain left in the broader markets and the benchmarks as well?
Yeah, thanks for having me here. I think if you look at our September fact sheet, you would have seen probably the highest cash level ever that we've got. We would have about 22% cash across most of our funds. And the reason was that it was quite difficult to get companies with reasonable amount of earnings growth of, say, roughly about 20-25%. Even getting 25% earnings growth for most of the companies across sectors was quite a tough task. So we are seeing slowdown across the space, across sectors. And hence, if you look at our portfolios, which were a 30-stock portfolio, is now moved on to 22-stock portfolio because we just have to be much more sharply positioned. 2 things that we are seeing. One is on the macro side, we are seeing some slowdown. Government capex is down 18%. If you look at, most of the other cases from the state side, state capex is also down about 8%. So I think the macro side of the market continues to remain quite weak. Corporate tax rate are in single digit. Electricity growth is back to 6-7% versus double digit in the past. And last but not the least, the personal tax growth, which looks like 24-25%. But if you strip off STT and capital gains, it's down to 8% on a apple-to-apple basis. So whether it's macro, and then if you look to company specific or corporate earnings, if you look at banks, broadly roughly about 5-7% kind of a PAT growth for most of the companies. Large cap IT hasn't done extremely well. We are seeing again low single digit growth there. If you look at capital goods, which have been the darling of the street, we do believe a large part of the capital goods is really played out because, a large order book win was in the last 2-3 years. And post that, we have actually seen raw material prices coming down. And hence, a large amount of benefit is because of margin-led rather than top-line-led, which obviously is quite short-lived. And we expect that to kind of reverse in the next 2 to 3 quarters. So I would say capital goods is pretty much towards the last leg of its rally. And hence, the only sector then left is IT, telecom, consumer discretionary, NBFCs. I think these are the 4-5 spaces where we've kind of hidden ourselves. And within manufacturing also, some of the spaces like defense, where valuations have really caught up in the last few years. We are actually now moving back to wires and cables, where I think there is reasonable amount of visibility of growth. So it's a very, very narrow market. We expect market to be quite polarized. We anticipated that this quarter will be quite weak from an earnings growth standpoint, hence the high cash. But as things stand, we believe large part of that correction is played out. Maybe another 1 quarter of correction can be possible. There's expiry week and all of that. But fundamentally, we believe that a large part of the market participants aren't factoring in the US election. We believe if a favorable outcome of US election, which is on 5th of November, can really change the course of the market. And we do believe that we will still have a big year-end rally in November and December, and we hopefully will end the year with a lifetime high.
So you are looking to deploy the cash that you're sitting on, considering where, most of the correction is done. There is a year-end rally. And would you go back to your favorites, IT, telecom, consumer discretionary, NBFCs? Or are there new trends emerging or green shoots emerging?
I think the kind of pessimism which is there on the auto side, it's kind of been quite, a lot of stocks within the auto space have been beaten down quite sharply. So I think there is some value emerging there. So we would have looked at some of those spaces, but otherwise, I think broadly sticking out to those sectors as such.
The other space that you like is telecom, Niket, and this is something that you've liked for some time now. Do you think there's still enough triggers left there? And what are those triggers that you're looking at? Because now there are a handful of participants in the listed space.
So I think, if you look at telecom, it's largely penetrated category. Volume growth is just barely 1 or 2% at best. But I think a lot of people aren't getting the fact that India needs to take a tariff hike every year. If the number 3rd player has to survive, there needs to be more tariff hikes. So I think our base case is that we will see a 15 to 20% tariff hike every year for the next 2 years from now. Probably it can be April, May, June, anyone's guess. But we expect a yearly hike of about 15 to 20%. And that really changes the cash flow economics for at least the number 2 player, which is listed. And hopefully at some point of time, the number 1 player will also look at listing, which will obviously benefit some of the listed players as such.
Up until now, the tariff hikes taken by the telecom companies have been after a period of 2.5 years. But the converse argument, Niket, for this is that for a telecom hike to be absorbed, it takes 2 to 3 quarters till the entire pass-through happens. So therefore, to expect one immediately after in another quarter seems to be on the higher side, but that's the converse argument. Talk to us about technology. Now, large cap IT numbers were fine, in line, but there were no blockbuster numbers. But today we've got numbers from Coforge, Persistent, and they've blown the lights of the market. Stocks have reacted with a 10% up move. So mid-cap versus large cap, and the next 1-year outlook for IT, according to you, the thesis.
So I think we are broadly clear that large cap IT is going to struggle at least for the next 2 to 3 years. Given the size that they are at from a revenue standpoint, you will always see at best, low double-digit growth, assuming the environment completely turns around, right? So we have been in the mid-cap IT space, and you would have looked at our fact sheet. We are very, very large in some of the mid-cap ITs which have reported numbers yesterday. I think in the next 2 quarters, small-cap IT will start becoming quite interesting, and that's an area where we are continuously focusing at this point in time. We haven't done anything material, but I think it's kind of getting slightly more interesting from a valuation standpoint as well as from a growth bottoming out standpoint. So I would really look at small cap IT rather than large cap IT at least for the next 2 to 3 years.
Okay, so you look at small cap IT versus large cap IT. Niket, the other part of, we would say, the IT arena, if we extend it, it'll be digital services in general. Is this a space that you're looking at? We do have some of these platform companies. Are you liking anything there? Zomato reported numbers yesterday. There have been big deals brewing. Swiggy is coming up with an IPO. Are you still bullish after that run-up that we are seeing?
I think we need to consolidate, given the way valuations have really run up for some of these spaces. Having said that, I think in a 100-meter race, I think we've just completed 10% of it, right? So still 90% to go, in my opinion. And I think this is a very, very big value migration trend that we are seeing. Look at the traditional FMCG guy. If today there is a new brand which is wanting to launch a soap, for example, had no, in the past, he would get fearful because there was no distribution mode that he would have got as compared to some of the large listed companies. Today, he can actually go on some of the quick commerce guys, get themselves listed, and can immediately get that traction on board. So we clearly expect this value migration to continue. The SKU ranges that some of these quick commerce companies are going to launch, I think it's going to be quite wide-brained. Today, if you look at the square feet area, it's about 3,500 square feet for a dark store. I will not be surprised that in the next 3 to 4 years, we will have at least 10 to 20,000 square feet stores for some of these companies. And hence, this will become a one-stop solution for any customer to go for any product under the umbrella today. So I think this value migration is likely to continue. The kind of growth rates that we've seen from some of the quick commerce guys, I think will at least continue for the next 2 to 3 years. And the surprising part is that the tier 2, tier 3 markets continue to do far better than tier 1 markets, right? The break-even point is about 1,800 to 2,000 orders a day. And if you look at tier 2 markets are actually doing that in 1 month or 2 months versus a tier 1, which is taking about 4 to 6 months. So I think the tier 2, tier 3 is a big surprise here. I don't think anyone thought, including us, we never thought that tier 2, tier 3 will become so large. But I think now it's enough and more evidence that some of these businesses are actually made for pan-India rather than just tier 1 markets.
Yeah, so there's a big opportunity that's brewing in Tier 2 and Tier 3 cities. So, Niket, in that case, would you look at these companies versus, say, traditional FMCG companies? DMart spoke about that big competition they are getting from QCOM. So, for the next 2 to 3 years, do you think there could be some persisting demand issues in the FMCG space?
That's pretty, we do expect some of that thing to clearly play out. But the other important part is that look at the FMCG trade channel. The regular trade channel, the regular mom and pop distribution channel that FMCG used to thrive on is under serious threat of survival right now. And in the next 2 to 3 years, if everything, a large amount of traffic moves to quick commerce, I think some of the unit economics of the traditional channel will clearly get impacted. And that's, I think, something some of the listed companies have already called out. I think we do expect some of that to play out even further, at least in the next 1 or 2 years.
You spoke about NBFCs. In the NBFC category, what is it that you like? And are you worried about increased stress? Because, for instance, Bajaj Finance is also now talking about, the best of the breed, talking about an increase in the credit cost guidance. So how would you manage the stress? And also, if you have time, I wanted to squeeze in one more question on auto, but we'll get to that.
So I think within NBFCs, I think we are quite clear that we have to be very sharply positioned. I think the unsecured part of the market is quite scary. When we look at personal growth, personal loan growth, if you look at credit card growth, and then if you look at the consumption data, it doesn't add up, right? And it feels like a large part of that capital has moved to equity market. It feels like that. There's no evidence for that, but it feels like a large part of that channel has moved to capital markets. And hence, there is going to be stress in the unsecured side of the market, at least for the next 4 quarters, right? And hence, I think our clear focus has been that within NBFC, if any company has a large unsecured portion, we want to stay away from it. And hence, we would move more towards the secured guys within the NBFC space. Within the bank space, I think we are right now 0% weight on banks, which is quite unusual for us because there is just no earnings growth on the bank side, at least for the next 2 to 3 quarters. And I think if that has to change in the near future, we will relook at it. But at this point in time, we believe that most of the banks have squeezed out every line item possible, whether it's credit cost, whether it's NIM. And I think there are multiple headwinds going forward for the banking space, at least for the next 2 to 3 quarters point of view. While they're cheaper from a valuation standpoint, but they're cheaper because there's no growth. If the growth was 25-30%, I don't think they would be available at the valuation that they are.
Okay, and a quick word, where is value emerging in auto? You appear to say that the pessimism seems to have been overdone a bit.
So I think a large amount of pessimism around festive season was quite overdone. We haven't seen that kind of pessimism on the ground. There can be company-specific issues at all points of time, but we are seeing some green shoots on two-wheeler side on festive. We are seeing some green shoots on four-wheeler side on festive. Commercial vehicle continues to remain quite slow. So I think given the correction that we have seen in large two-wheeler and four-wheeler names, they might be interesting for a 15 to 20% rally.
All right, take that point, Niket. Thank you so much for joining in today. Always a pleasure speaking with you. That's the word coming in from Motilal Oswal. AMC, they expect the year to end with record highs on the Nifty as well. We'll slip into a short break. Up next, we'll discuss what's buzzing in commodity space with Manisha Gupta. Welcome back. You're still tuned into Trading Hour. Let's talk about the commodity space. Manisha is joining in, and today we are focusing on palm oil. Manisha, some recovery here?
Well, yes, a strong run-up in the prices actually, and let me tell you that palm oil as a commodity is used in your cosmetics, in your detergents, in your processed foods, if you're eating out in sense of namkeens, and it has a huge use in hotels and restaurants as well. So this is what we've seen in sense of prices going on the higher side. Well, the prices also have gained because of strong demand. Most of the other edible oil seems to be doing well as well, and that is the reason you have seen palm following that up on the higher side. Strong export numbers from the producing countries. You also have Malaysia, October numbers showing much on the higher side, up by nearly 9 to 10% of export jump up. That has been positive. And then the firm crude oil prices also are supportive because there's a mandate on palm as a biofuel also. So every time you see crude oil prices go up, palm oil prices also tend to gain there. So if you look at the price moves that we have seen overnight, it has been a 3% of a jump up. With that, palm oil prices now are 4% up on the week, 13% up in last 1 month. And when you talk about the current year itself, 21% of gains here as well. Most of the edible oil prices have been surging as well, and this is ahead of the festivals, and palm oil prices actually leading all of that back on the higher side.
Thank you very much for that. We'll do the discussion on silver another time, with silver prices in India crossing that 1 lakh mark per kg, having risen close to about 40–50% this year. But we'll leave you with some good news as we slip into a short break. 1 million Indians are now making smarter investments with the help of Money Control Pro. Money Control Pro, which is a part of the listed entity Network 18, has crossed the milestone of 1 million paying subscribers. The site closed September with over 53 million unique visitors, 30% higher than its closest competitor ET, underlying the fact that Money Control Pro is India's platform of choice when it comes to financial decisions. So if you haven't subscribed yet, scan the barcode on your screen and become a part of the Money Control Pro family and help yourself make better financial decisions.
And Money Control also celebrated the 1 million subscriber landmark this morning by ringing the opening bell at the National Stock Exchange. The editorial team of Money Control Pro was also joined by India's leading investors, market minds, and movers and shakers, including Ashish Chauhan, the MD and CEO of the National Stock Exchange, Sameer Arora from Helios Capital and Edelweiss's Rashesh Shah, for a special chat on the power of Indian equities.
Welcome back. The company on our radar today is Route Mobile. The company's top line has seen a growth of close to about 0.9% on a quarter-on-quarter basis, and on a year-on-year basis, the revenue growth was 9.7%. Margins came in at 12.1%, and profits have crossed that 100 crore mark. The company has retained its FY25 top-line growth guidance of 18 to 22%, with margins of 13%. Gautam Badalia, Group Chief Strategy Officer and the Chief Investor Relationships Officer at Route Mobile, is now with us on the show. Gautam, hi, thank you for joining in. This is Rima here. So first, to get to your guidance of 18 to 22% for the full year, you will need to do about an 8–9% growth in Q3 and Q4 on a quarter-on-quarter basis. Now, that appears to be on the higher side compared to the recent run rate. How will you achieve it?
Thank you, Rima, for having me here, and good morning, everyone. So, from the last quarter standpoint, I think it panned out to be a good quarter for Route Mobile. But for about 7 days, I think, where we had a platform glitch, which was really outside of our control, the platform really panned out well. I think we have kind of been getting now in the momentum of large deal wins. I mean, we won a large e-commerce deal. And that is, again, I mean, across 10 plus countries, largely in the European market. So, and there is some seasonality into the business. I mean, H1 usually pans out to be 47% of revenue. And H2 is where, because of the festivities, pans out to be a very, very strong kind of second half. And basis the run rate, I mean, for the early 20 days, I mean, the first 20 days of the month, I think we are very, very confident. We are reasonably confident that we should be able to kind of deliver the growth that I think we've already committed to in terms of the guidance.
So can you tell us the growth that you've seen in the first 20 days of October?
So on a YOY basis, I think we're looking at 15–20% growth already, I think, in terms of the run rate.
In the first 20 days of October, right? You've seen a 15 to 20% growth.
That's correct.
Okay. So, you spoke about how some days were impacted in the quarter gone by, and that impacted revenues. Is that the same reason why margins have been lowered? In the first half, 12.4% is the margin. Your guidance is 13%. Will you be able to achieve that? What would be the key drivers there?
So the good thing is, I mean, the business today, I mean, works on a very fixed, I mean, a large part of the OPEX cost is fixed in nature. So if you are able to drive revenues and drive margins, I mean, there is a natural kind of an operating leverage that plays out. So if we are talking about the kind of growth for H2, I mean, if we are able to kind of deliver that, which we are reasonably confident of delivering, it should percolate, I mean, to kind of the expansion of margins. So from 12.2 to 13%, which we have guided, I mean, we should largely be able to deliver that. Historically, we have delivered a 13.5% kind of a EBITDA margin for H2. So for at least Q3 historically. So I think we are fairly confident we'll be able to kind of deliver the revenue and the margin guidance. And the other parameter was largely the cash flow conversion. I think we have done fairly well there. I think we've been able to reduce the receivable days and also kind of, I mean, about 78% was the EBITDA to cash flow conversion.
I remember in the past you'd spoken about weakness in the international business. What is happening on that front?
So typically July, August, I mean, they are holiday seasons, I mean, internationally for a lot of markets. Despite that, I think the rest of the world business, I mean, for us, they've grown in terms of volumes. A little bit of impact, I think, is largely there in the MR messaging, which is our wholly owned subsidiary, largely catering to continental Europe because of geopolitical issues. I think they have kind of been grappling with a little bit of a headwind there. I mean, but for that, I think the rest of the world, I think we have done well, and some of the large contracts that we have won. And one of the large RFP that we have, it's a global RFP again. I mean, it's a mega RFP from our perspective. If we are able to get a meaningful bite into that RFP, I mean, that will augur really well, I mean, from a FY26 growth standpoint.
You know, the other segment which has done well for you so far has been the new product sales. But this time around, the growth has come at 32%. Previously, you've seen growth of around 93%. It's been 75%. Do you think now growth levels will slow down in new product sales? And how much will it reach in terms of double-digit contribution to sales? By when, I mean, sorry.
So I think we've done fairly well. I mean, we've delivered our 32% YOY growth. The good thing is, I think the last quarter essentially was the building block. I mean, with the group, with the Proximus group, to kind of create the right sales motion to drive the cross-selling of the new products. So, and we've already bid for a few large deals globally with large marquee enterprises. Hopefully, I mean, if some of those were to fructify during the course of this quarter, I mean, that will really kind of give additional leg to the new products momentum.
Can you give us some more color on these large deals that are in the pipeline that you've bid for the new product segment?
I mean, so some of these are large global companies where, I mean, they were looking at, I mean, products like email solutions. So we bid for a very large RFP on our email portfolio. I can't actually call out.
So what's the size of these large deals? What's the size of these large deals that you bid for? And when are you likely to hear?
It's premature to call it out right now. I mean, let's first, I mean, once we have it in the bag, we'll definitely come and kind of call it out.
But if they do fructify, do you think your growth can get back to 50% plus? Just trying to understand the significance and the way forward. And when are you likely to hear back?
So as we said, I think on the new product side, I think on a quarter-on-quarter basis, we have been kind of, I mean, the revenue contribution of new products has been increasing. I think the endeavor today, I mean, it is at about a 7% contribution to the overall revenue. And the endeavor is to kind of double that over the next 2-3 years. So some of these deals that we are talking about, I mean, these are large deals. And thanks to, I mean, the global reach, I mean, that we have today, I mean, we are now able to participate in a lot of these deals. So, but for that, I mean, because of confidentiality and stuff, I mean, we'll not be able to call out any numbers right now. But whenever it fructifies, we'll be happy to kind of come in and kind of give you a perspective.
You want to double it to 15% in 2 or 3 years or longer?
Yeah, between 2 to 3 years, I think we should look at doubling it.
Okay. Gautam, a note by HDFC Security, it assumes that there will be 18% YOY growth for FY25, which is within your guided range as well. They say it will be 8.5% growth from the Vodafone Idea deal and 9% growth from the base business. Is it fair to assume that the base business will see a single-digit growth this time, or you will be able to do it in double digits?
No, so I mean, strictly speaking, I mean, just wanted to kind of also clear this perspective. So Vodafone Idea actually is the supplier, right? I mean, so we are driving the growth from customers. So technically speaking, I mean, the entire growth that we're talking about is organic growth coming from large customers, where we have the benefit because of the supplier arrangement that we have with Vodafone Idea.
Okay. So we can't bifurcate it in terms of how much from the Vodafone Idea incremental deal versus the base business. Is that what you're saying?
Yeah, so I mean the business is actually driven, I mean, from growth coming from existing and new customers, but we have a commitment with Vodafone Idea in terms of the volumes that we're going to mobilize for them. I mean, so we are fairly so we have done fairly well. I mean, in terms of H1, H2, considering the seasonality, we should be able to kind of fulfill that obligation for this year with Vodafone Idea.
Okay. Gautam?
Okay, all right. Gautam, thank you so much for joining in today with those thoughts and the outlook going forward. That's the word coming in from Route Mobile. They stick to their guidance of 18 to 22% revenue growth with margins of around 13% in FY25. We'll slip into a short break. When we come back, we'll discuss market technicals with Mitesh Thakkar and also discuss the top trading bets. Welcome back. So the markets have picked up some pace. It happened a while back, but was sold into. But again, Nifty is picking up space with a 106-point uptick. It is at the day's high, and some of the contributors, we have Reliance Industries, which is at the day's high. That's a big weight on the index, and that is the one which has moved to the high point of the day. Some of these consumption names, Tata Consumer, for instance, is at the day's high. We also have Britannia and Asian Paints, which is contributing to the gains that we are seeing right now. We do have a lot of consumer earnings as well today and tomorrow, so consumption sector will continue to be in focus as well. For now, let's get to the technicals of the markets. Mitesh Thakkar is joining us for just that. Mitesh, what is the next important level to watch out for on the Nifty? Do you think we will be able to sustain these levels for today?
I think so. On the index, my belief is that there could be a possibility of a short-term low being made purely because of the fact that we are extremely oversold. So given that kind of a setup, I think, it is quite possible that the markets might see a stronger than expected bounce back. I was looking at 24,600 as the first level in the morning. Eventually, with some volatility, we might even head towards 24,800, 830 zone, even take a few points, I think, which is where the market was earlier taking support. So it looks like a pullback coming into play. And for the timing, I think it might be wise to take profits if you're carrying any short positions.
And what would your individual trading bets be, Mitesh?
So I think IT is a sector, which is showing clearly signs of strength, and that is, in fact, the most strong sector today. So I have a buy on Tech Mahindra, which I would recommend buying with a stop below levels of 1710 for targets of 1790 or thereabouts. And the other one is Oracle Finance, which is a buy as well. Keep a stop below levels of 11,100 and 11,117 over here, and look for a target of around 11,800.
Thank you very much for that. We'll get into a break. Before that, here is a small programming note. As we prepare to ring in the festivities this Diwali, tune in to CNBC TV18's Market Movers Forum. Tomorrow, 3 p.m. onwards, featuring guests like Ramdev Agrawal, S. Naren, Nilesh Shah and others to help your portfolio prosper this Diwali. Welcome back. Now, IT is clearly the sector of the day. The Nifty IT index is up close to about 2.5%, and individual mid-cap names like Persistent, Coforge, Zensar, where the numbers were okay, even that's up close to about 6.5%. So quickly, let's take you through what's working for these IT companies and what they've reported. One, Persistent Systems, and this is a stock which has done so well. Its 5-year stock price CAGR is 75%. Despite that, the stock continues to move up 10%. The reason is growth and growth. The company continues to deliver strong growth and higher than the industry this quarter at close to about 5%. Secondly, growth was delivered by banking and financial services, which we know is strong. But a vertical which was impacted for the company, high tech, it's nearly 40% of their revenue, but that is expected to recover, and the company holds on to its aspiration of achieving $2 billion by FY27 and expanding margins by 200 to 300 basis points over the next 2 to 3 years. Now, Coforge is the other one, where the management themselves is saying that this is going to be a standout year for the company. Very strong. So reported numbers get boosted up because of the Cigniti acquisition. But if you strip that out, organic revenue growth was 6.3%. And the company says that momentum will sustain in Q3 and Q4. They will be robust quarters despite the weak seasonality because of, look at the way their order book is. Their order book itself has gone up 40%. Which has to be executed in the next 12 months, which means the next few quarters are going to be strong. Even on margins, the company said that they're confident about exceeding their gross margin guidance of 50%, either 50 basis points. Either they achieve it or maybe they'll try and beat it. And even Cigniti, this was an acquisition which the company did a couple of quarters back. There was a lot of skepticism surrounding it. I remember when the acquisition was announced, the stock fell. But Cigniti is turning around. This was the first quarter where they've consolidated it. And look at the Cigniti numbers. Revenue growth 6%. Even the margin performance is likely to be better than what they had earlier anticipated. Now, Zensar is saying that Q3 will see an impact of furloughs, but overall the impact of furloughs will be less than what we've seen in Q2, and Q3 will be better than Q3 of last year. Margins will be mid-teens within a tight band. Their pipeline is good, and the company is working on a few large deals. But a quick word, pull up even other stocks like First Source, and the other one is Emphasis. Now, these are companies with very high BFSI exposure, and we know BFSI has done well for all the IT companies. So Emphasis reported their numbers. BFSI was an okay performance, but I think the expectation is that going forward, things will only get better. So Emphasis is seeing a bit of a late reaction now.
So there's some focus on the small cap or the mid cap IT space more than the large caps. Even Niket was saying
Niket was saying, right, large cap IT companies have not delivered this kind of growth rate, which you are seeing with mid cap. Because of their large base, it's been what, hardly 1-2% kind of a quarter-on-quarter revenue growth. And these companies are talking about 5-6% revenue growth quarter-on-quarter. Year-on-year, of course, much more.
Yeah, so big move there. Thank you for explaining that to us, Rima. That's all about the mid-cap IT space, big moves that we are seeing in that sector. But let's move on. A small programming note as we slip into a break. The biggest market experts will be joining us in the CNBC-TV18 studios. And this year, we are giving you a chance to meet your favorite market experts. 5 super fans will get a chance to visit the CNBC-TV18 studios on Thursday to interact with the biggest market experts. Write to us on our social media handles tracking 25 years of CNBC-TV18 to take your chance to meet the CNBC-TV18 Market Movers Forum at 3 p.m. this Thursday. Welcome back. Well, there are some flashes at the bottom of your screen. It's coming in from Bloomberg, where they say that oil ministry has sought removal of windfall tax on crude, and they are reviewing scrapping windfall tax on crude altogether. Now, remember, it was levied 2 years back. 1st July 2022 is when the first time we got that windfall taxes on ONGC, because remember, crude oil prices were at record high levels, and that's why some windfall taxes were taken in from these oil producers as well. Currently, the windfall taxes are nil versus that 1,850 rupees per ton mark that we saw in the month gone by. This has been coming by in last couple of months, that there is a possibility of scrapping the windfall taxes altogether. If that does happen, these companies tend to benefit, but there's nothing final right now. We keep getting these news pieces where they say that there is a possibility. We heard the oil secretary also saying it on record that there is a possibility that would happen. But then again, it has to be approved by the finance ministry and the other leadership as well. So for now, this is coming as reports. We'll have to see which way things go.
Okay, that's the latest there reports as of now. But let's get to the earnings then. Again, a big day. HUL will be reporting Q2 numbers. Mangalam is here with the key expectations. Mangalam.
Well, for HUL, if you look at the macro setup, there has been rural recovery, but it may be offset by some urban slowdown. Price reductions will lessen this time around as the company talks about, price and volume gap narrowing, and raw material prices are also firming up. And more importantly, remember the company has taken an increase of almost 25 basis points of royalty to the parent. At the same time, GSK Consumer, the OTC business comes off, and there were one-offs in the base as well. So all of these things will impact the reported numbers. But put all things together, what are we expecting? The key metrics to watch out for will be 4 to 5% sort of volume growth that will come by, led by 1% price cut, and margins will remain stable year on year. Revenue, as a result of which, grows about 2.5%. You're looking at a number closer to 15,665 crores. EBITDA grows 1.5%. That implies that margins stay around that 23.5% mark itself. And the net profit sees a mild decline of about 1.5% at closer to 2,700 crores is what we're looking at. Volumes between 4 to 5% is something that the street will like. Two things I'll be watching out for in particular when it comes to the segments. Beauty and wellness, the segment that they carved out last quarter itself in terms of reportage, should grow higher than the industry, should grow higher than the overall category. And also, we have food and refreshments, which should grow 5 to 6%, largely because of inflation and tea and coffee. Home care expected to grow 4 to 5%. Personal care expected to stay flattish due to, reduction in price cuts. What's the outlook on the ice cream business? The future for that is something that we'll also keep an eye out on from the management, apart from festive season demand.
Okay, all right. Outlook on the ice cream business. Thank you for that. That's what we're expecting from HUL. But Mangalam, Pidilite will also be reporting its numbers. A busy day for you?
Yes, a busy day. There's going to be Pidilite. There's also going to be United Spirits after the market. But for Pidilite itself, it may be a bit of a washout quarter, largely because the second quarter is, seen a lot of excessive rains. And for building products, typically, it is not seasonally one of the stronger quarters. But there will be pickup post-elections, and that will be offset by excessive rains. So there will be a bit of a tug-of-war. Important to watch out for margins and the volume as well. So if you just take a look at, the revenue growth of the company this time around, we're not expecting much in terms of middling sort of revenues, 6% revenue growth, closer to 3,500 crores on the top line. The EBITDA grows a shade faster, so we're expecting the EBITDA to grow by almost 9%, which implies a margin, an EBITDA of around 770 crores and a margin improvement as well on the cards for Pidilite by about 50 to 60 basis points. The net profit also on the back of that grows. The consumer and bazaar, which is basically the Fevicol and Fevikwik products that we all use, expected to see volume growth of anywhere between 8 to 10%. Over the last many quarters, the company has been outperforming on the volume front. But importantly, tracking the margins would be crucial from here on, largely because they are now at the higher end of the company's guided band of 20 to 24%. We are expecting gross margin expansion of 200 basis points. But the key raw material prices, which is vinyl acetate monomer, the prices have now seemed to bottom out as per the management. So going forward, margins would be crucial to track.
Thank you. And let's find out what's the expectation from TVS Motors this quarter. Sudarshan now joins in. Sudarshan, Bajaj Auto really spoiled the mood with its management commentary. So now all eyes on TVS Motors.
That's correct. So for TVS Motor also, we are expecting on the earnings front a healthy set. But more than earnings, what would be important is the commentary related to demand, and especially during the festive season. But first, talking about the earnings expectations, profit is seen rising 31%. Revenue may increase 16%, aided by healthy volume growth that company saw during Q2. Q2 volumes were up 14% year-on-year and 13% sequentially. EBITDA is also expected to rise 18%, and margin may expand by almost 100 bips year-on-year. And the margin is seen being aided by operating leverage, while a drag can come from increased raw material cost and higher two-wheeler electric vehicle sales. In the management commentary, the focus would be on first, e-mobility initiatives and demand outlook. Second, if there is any divergence in demand between rural and urban area. Third, FY25 guidance for domestic and exports. Fourth, updates on fundraising if company has any plans for EV company. And last is updates on ramp-up plans and new launches if company has for electric vehicles. So overall, numbers are going to be in line to slightly better than estimates, but focus would be on the commentary that company might give for the festive season.
Thank you. And that brings us to a close in trading hour. From the entire team, Sonal, me, thank you for watching. Stay tuned. Halftime report is up next.